So thank you for being here today. We'll open it up with Tax Cut and Job Act. So this is a new major law that was passed in December 22nd last year. And it affects individuals, other for-profit entities, but it also affects non-for-profit entities. And this is why we have changed the title of this presentation to Tax and Job Act, because it doesn't really cut taxes for non-for-profits. There are a few specific provisions that it covers and that we're going to talk about today. Some of them are more applicable to you than others, but we wanted to give you idea and information about them so that if you do come across some of them, you know what they are. And also, if you have questions, you can call us. So there is a new tax on excess executive compensation, and you might not think it affects you today, but it might affect you in the future. There is excise tax on investment income of private colleges. Unrelated business taxable income, it's now calculated different way, which means it's calculated by different income stream. And the new provision, who nobody knows anything about, is the new tax on disallowed fringe benefit expenses. So we'll start with the tax on executive compensation. Prior to enactment of the act, the non-for-profit organization, as you are aware, only needed to comply with making sure that the compensation of executives was reasonable and there was no private inurement. This act puts non-for-profits in the same light as for-profit organizations with Section 162M, and it really talks about the fact that if you have highly compensated employees, and that highly is defined as $1 million, you're going to be taxed on that excess benefit. This is effective for tax years beginning after December 31st, 2017. This is the code section. I know it's very boring, but we wanted to put it out there because it does talk about who this applies to and why this applies to you. So it talks about specific tax-exempt organization, and it defines the highest compensated employees as covered employees, and it has to be over $1 million, plus if there's excess parachute payment for any covered employees again. So we went through some of the definition, who is that applicable tax organization, because it might not necessarily apply to you. But if you see the laundry list, there is really very few organizations that are excluded from this. The covered employees is one of your highest compensated employees, one of the 5 highest that they're talking about. And if they're not a covered employee today, they might have been in the past. And once you hit the list, you're always on that list. You never go off, even if you're not part of the organization anymore. And then they talk about remuneration. How do they come up with that $1 million? So you talk about the regular wages, your regular compensation, right? You look at your 990, and most of the people on it are not paid over the $1 million every year. But what this comes to play is when you have executives retire and you had a 457F plan where you accumulated all those earnings over the years, and now they get a payout. So now, in their W-2, that compensation is going to be over $1 million. And that's when you're going to get hit with this tax. So like I said, it might not be every year, might not be something you see out there, but that's something that you should consider how you pay out that compensation, how you plan to structure, because it might hit you at some point in the future, especially when some of these retirements come into play as executives move on. And this does not apply to medical professionals and veterinarians. So if you have a license to do those things, you don't need to worry about that. And the other thing, the $1 million is plus excess parachute payment. So what is the excess parachute payment? It's a payment for separation of an employee, and that excess comes into play if it's 3 times the base amount. And they define the base amount as compensation plus some of the other payments that come into play. So again, if that payment for separation as a separation agreement, it's over 3 times the regular compensation, that's when you could be hit with that tax. So I don't want to go too much into it, but I wanted you to be aware of it because there could be some planning opportunities that you might want to look into, because at some point with some of these plans, this might come into play. Next fun tax.
Okay, that's for the penalties of a big endowment.
Right.
Yeah. What they're really talking about here, and again, this is affecting colleges and universities, where there's been a concern over the years that the endowments are going larger and larger and larger, and the tuition is going up. But what's happening is the idea is that they're not using the endowment fund to try to supplement and keep any of the costs down. And as far as for those that it's actually going to affect, there's one interesting thing about it is the fact that they're the excise tax, which actually appears very much like Section 4940, which is the excise tax for private foundations. They're using a rate of 1.4. And what's interesting about that is that there has been 5 different attempts at coming up with a single rate for private foundations at 1.35 or 1.39. So my bet is that on the next go around, we're probably going to see the single rate for excise taxes for private foundations at 1.4. But this is purely mechanical as far as this is concerned. It's for colleges and universities that have over 500 students, and if you take the number of students divided into the endowment, where the excise tax kicks in, is that if you have over $500,000 on a per student basis, that you're going to get hit with the excise tax. And more than 50% of the students have to be located in the United States. So this is not one of those cases where you could have campuses over in Europe or other places that it's actually going to have an impact. And they use something called equivalent units when they're doing the calculation
of humans,
on who's
right?
a student. Yeah, it's part-time students are based on equivalent units, where you would take and see how many. It's based on full-time students, so they see how many full-time students you have based on your equivalent units. Okay, as far as the assets are concerned, this is calculated on is the fair market value of the assets at the end of the filing year preceding the tax year. Okay, so it's always going to be retrospective on the calculation, prospective on the as far as the effect is concerned. And it can include the assets of a related organization. So this would be a case where if I've got a college and university, and I've also got a foundation where the endowment's in the foundation, and the foundation is related or controlled by the college or university, which gets in another whole set of definitions. But it's going to have an impact as far as what the university does. And the tax is going to be on the net investment income. Again, they're using pretty much the same definition that they use with the private foundations, where you take your gross investment income against your directly related expenses. And it excludes UBIT. If you have unrelated business taxable income already calculated in there, you're going to subtract this out of your investment income. Again, the same way that you would do it as far as the private foundations are calculated.
So now we get into the fun stuff.
What's
for
that?
us, at least.
Yeah.
And this is the UBIT siloing. I'm not sure how many of you are concerned with this, but this is a very hot topic for us, the tax people. And this really talks about the fact that IRS has been trying to do this for years, and they finally came out with a law when they put it in place, and they're very happy about that. We as the tax preparer and the organizations are not so happy about that, because there's very, very limited guidance on what to do. But this is one of those provisions, again, as Rob mentioned before, is where they're trying to put the non-for-profit organization in par with the for-profit entities. So in the Congress's mind is, if you run a different trade or business and you're receiving a revenue, you should be no different as a for-profit entity doing the same things. Because they cannot necessarily consolidate that income, they don't want the non-for-profits consolidated either. So that's why they put this law into place, to make sure that you calculate it on separate basis. Since this has been such a limited guidance, they put out this notice 2018-67, which provides, again, very limited guidance on what to do. So there are some choices.
And I think one thing that's interesting to point out about this, to say the least, this code section 512A6 and the one we're going to talk about next, which will be a little bit longer, is on the transportation on the 512A7. There are currently 3 bills in the Senate, U.S. Senate, and one in the House to try to repeal these sections. Okay, now whether that's ever going to happen is your guess is as good as mine. But the general speculation is that it's not going to happen. So these are things that we're going to have to live with.
Right, they're here to stay.
Yeah, and the Council of Foundations has asked the IRS to postpone it for a year because there is really a lack of guidance in this whole area. And Magdalena and I have both read this 2018-67. How many times?
Way too many.
Way too many times. And somebody was not an English major who wrote it. So it doesn't.
But it's 34 pages that will put you to sleep. So if you ever cannot sleep, pull it up. I guarantee you'll be out.
Right. Yeah, it'll put you to sleep real quick.
So the one thing we wanted to point out is because in IRS's law, everything is defined somewhere. And there's one thing that's not defined anywhere, which is UBIT, or trade or business. So this is their definition of what unrelated business taxable income is. And it's gross income derived by an organization from any unrelated trade or business regularly carried on, less deduction and modification in 512B. Now they added this new code section, 512A6, which provides more detail on what UBIT is, again, without defining what trade or business is, but it talks about unrelated business trade income. And it tells you that you have to compute it separately with respect to each trade or business, including for purposes of your net operating losses. And then you have to sum it up with respect to such individual trade or business, and it cannot be less than 0. So again, somebody's trying to dissect it, and there's been many, many articles about this. And again, we have no guidance on how to apply this. Notice 2018-67 talks about determining the separate line of businesses without providing that definition, but it tells you that you could use a reasonable good faith interpretation. What they trying to get away from, whenever you say facts and circumstances, reasonable good faith estimate, you're going to define it, everybody's going to define it differently. So the fact that they haven't defined what trade or business is very scary, because you could have 3 organizations doing the same thing and reporting it differently, which is administrative nightmare for the IRS to control and comply with. But again, this is what we have to go by. So they talked about using a reasonable good faith estimate. So Rob, you want to talk about the good faith estimate, how you can figure that out? It's just reasonable basis. So whatever is reasonable to you, whatever is reasonable to a regular person, that's how you would define it. Facts and circumstances, again, you're going to look, what are you doing, how are you doing it, whether you can combine it or separate it. So it's really have to look at the reasonable person approach. They did talk about using these codes that you see on the first page of 1120 and a 990, that if you put yourself in that line of business and the other line of business doesn't fit in that category, it's different. And they also talk about fragmentation principle, which really comes into effect when you're providing something for dual purposes. Something is related to your mission and not related to your mission. And a good example is, for instance, if you have a pharmacy, and to your pharmacy you have your own patient come in and you have non-patient. So the patient is not UBIT, but the non-patient is UBIT. So that's where the fragmentation principle comes into play. So they literally threw all these things at you, and they said, we want comments and let us know what's going to work. They did talk about allocation of the directly connected deductions, and those are much easier to figure out, because it really, what you're looking at what does it cost you to do that. So the directly connected deductions are much easier. The overhead allocation, there is a lot more judgment that comes into play to do that.
Yeah, and where a lot of the speculation comes in on this is when you're actually conducting a trade or business. Okay, the concept of UBIT, as far as unrelated business taxable income is concerned, there's really 2 sides of it. One is going to be pure and simply the trade or business side, which using the pharmacy. If you go, they always use the the pharmacy in the hospital that's selling drugs to hospital patients, and then also to the community, and and where that's going to be considered related or unrelated. And the other one that I think is probably more applicable, that we're going to get into in just a minute, is that where you've got this kind of UBIT that you don't really have any control over. And this is going to come from things like hedge funds, where you always worry about getting the K1, and the question is, what do you do with it? At this particular point, there was at one point in time before the guidance came out on some of this, where the minutia that they talked about breaking it down to was that line 1 on a K1, is that different than line 2 and line 3 and so forth. And so I think if you really look at the biggest value of 2018-67 is really going to be in those two particular areas.
Right, and that again comes down to defining the trade or business. If you do advertising, you know that it's a trade or business. But if you get K1s, is one individual investment in separate trade or business versus the other? What if there is any debt finance property and you bid on that? Is that a separate trade or business? Which is why it's so important that the definition of what trade or business is, which is the big unknown that we have right now. But we can use the reasonable principle and facts and circumstances test to rely upon that until further guidance is issued. And what Rob was referring to is this investment activities, the partnership interest. And again, until the further guidance is issued, they do give us those two principles that they can rely on. So if you have partnership investment with multiple underlying tiered partnership, they're called investment, you could treat that as one trade or business and aggregate all of that. As long as you meet the two principles, the de minimis test and the control test. And the minimis test, that's really easy because that's something you can actually look at your K1 and it's factual.
It's going to be on the lower left.
Right. You're going to see as long as you own less than 2% of capital and 2% of interest, you pass this test. And the second test, the control test, I think is also really easy because you're going to know who you actually control. And this control definition generally in non-for-profit world is more than 50%. This goes down to 20%, but again, I think that piggybacks of the excess business holdings for private foundation, which they try to connect a lot of things in this law. So it's if you have less than 20% interest in a partnership, you don't control and you can aggregate those partnership interests. And I think this was very important part of that notice because this is something a lot of organizations that not necessarily have a trade or business, but have investment activities. If you have any sort of hedge funds investment or any tier 3 investment, I'll call them, then that's something you would be worried about. So that's really good that they put it out there.
Yeah, and also I think just from a general standpoint, as far as the partnerships are concerned, that I've really found probably very, very few that go past 2%.
Right. Yeah. Because generally, if you're really into it, then the IRS can come back and say it's substantial, and then for all of it is UBIT, not only certain activities. So organizations do tend to get on a lower level.
And as long as you're below the 2%, you can actually, if you could have 100 K1s, and if you're at 1.9999
on each one of them,
on all the K1s you've got, then you don't have a problem. Okay, it's not an aggregation to get to the 2%. It's actually individual K1s that are looked at on a K1 by K1 basis. So what I think where you could run into a problem is if, let's say that 98 of them are below 2% and 2 of them are above the 2%, you could run into an issue there as far as
I think that would be 3 separate lines of businesses, right?
Yeah.
And again, this comes into place because they don't want you to offset activities from one entity, one trade or business to another, because you would technically never pay tax, and they want you to pay tax. This is the Tax Job Act.
Right.
So the other thing that Rob mentioned before is that disallowed fringe benefits, which we'll talk about in a minute. This notice does say that this is not a separate line of business, which we interpret that you can use the NOLs generated from any of those lines and offset some of this tax that you're unfortunately going to be subject to.
Yeah, the one thing that when I was in some of the current reading I've been doing, we were talking about as far as the applicable dates that go into effect, and they were talking about the fact that investments that are held before the notice, are not they're not treated in the same way as the investments that are being acquired now.
After, right.
Yeah, so it's not a matter that I think, if you've got a bunch of investments that you had over the years, that all of a sudden you're going to be hit with, with
Right,
these.
they'll be grandfathered in
Yeah.
for the most part. The next portion that the notice did cover is the NOLs. And again, the new tax law changed how NOLs are calculated and applied for everyone. As a not-for-profit, you're part of those individuals or organizations that will be affected. So if you've done trade or business before, you will have your pre-Tax Act NOLs. And if you're going to do it in the future, you're going to have your new NOLs. So really the question is, well, how are we going to apply this? The only thing we know for sure is that you can only use 80% to offset that taxable income for the year. So this goes into very similar as the AMT tax, alternative minimum tax, where you would not get paid regular tax, but you would still pay the AMT tax. So this somewhat comes into, it's similar to that fact, but there is still not a good idea. In 2018, when you're going to file that return, you could use your pre-2018 NOLs, but nobody really knows what to do in 2019, whether you use the NOLs from year prior or you use your prior NOLs. So that's something we're waiting on for more guidance.
Yeah, and well, one thing that the IRS has said we haven't figured out yet is the ordering rules on the NOLs. And where that's going to come into play is that, first of all, is what NOLs are you going to use? Let's say that, and the reason this becomes relevant is that if you've got a large net operating loss carryover, that the theory behind it, depending on how they do the ordering, you could actually end up running some of those NOLs off the 20-year limit and actually not be able to use them. And so, for instance, a good example, if you were looking at the ordering on the NOLs, for 2018, there is no pre, okay? So from that standpoint, you're going to be using the carryovers from before 2018. What the IRS has said that they haven't figured out yet is that, let's say that I've got a net operating loss for 2018. When I go to 2019, do I have to use the 2018 first, or can I go back and continue to use my carry forward until I use it up? And they just said, wait, we'll let you know when we figure it out.
Right, and the new NOLs, they never expired. The old NOLs expired after 20 years. This one you can use until you use them. Potentially at some point you'll be able to use the losses. So this is all on the siloing and the new tax law. Again, it's really only effective if you have those investments that generate UBIT. The new items that we're going to cover is the new section that will affect you regardless whether you have a trade or business or not. And this has to do with the disallowed fringe benefits. So prior to the act, again, exempt organizations were not subject to taxes on any transportation fringe benefits provided to employees. This tax law provides a 21% rate on those benefits. We'll talk about them in a second. And again, as everything in this tax law, the Congress wanted to make sure that not-for-profit organizations were now better off as any for-profit entity who is right now not allowed to take deduction on their income tax form. But because not-for-profits are not taking a deduction because you're not paying tax, the Congress felt that you should be paying tax now on the allowance on these amounts.
And I think of all the sections that they've come up with so far in the new law, this is probably the one people are in denial for the absolute most. And part of it is when we'll be talking, for instance, transportation is a good example, is and people look at you like you have two heads when you start saying that your pre-tax on your transportation is taxable to the nonprofit. And because the chief counsel for IRS back, what was it, April, was the one that said that the pre-tax would be taxed. Now, having said that, I've called several occasions called to see what kind of an update there was. And the people I talked to in Covington said, I'm sorry, we're not allowed to talk about that. So, you're not getting any guidance from where you think you're supposed to. But right now, the whole thing is based on the fact that the chief counsel for the IRS said that these pre-tax benefits are taxable.
Right, and there is an important caveat in this particular code section, is because this is effective for benefits paid after December 31st, 2017, whereas everything else is effective for years beginning after. So you had one more year to adapt all the other changes. This is in effect now.
Yeah, this was as of
and this
1/1.
affects a lot of the fiscal year organizations because you got to pay that tax if you haven't already. This is the code section. 512A7, and it literally says that your unrelated business taxable income has to be increased by any amount for which deduction is not allowed under code section 274, which is paid on incur for any qualified transportation fringe, any parking facility, and any on-premise athletic facility.
And what's interesting about
So what does this really mean?
What's interesting about that is that in 2018-67 that we were referring to a few minutes ago, right in the middle of it, it says that 512A7 is not applicable because it's not UBIT. So, it depends on where you read it. What they're doing is they're using a little bit, there's something called Proxy Tax, which has been around since 1995. Excuse me. And they're using the 990T to pay the tax. Okay, that doesn't mean that it is, so they refer to it as UBIT, but it doesn't really mean that it's UBIT per se.
Right. I mean, as any non-for-profit organization, you're tax exempt. All these years you were trying to get away to do anything that's taxable because A, you had to pay tax, and two, potentially you were running on a loss of an exemption depending on how substantial those activities were. This is a code section where you didn't earn any revenue, had to pay the salary expense, and you still have to pay the tax on it. And again, as Rob mentioned, a lot of organizations were in denial for this, but unfortunately, this is the law right now, and very unlikely it's going to get reappealed. So what this talks about is if you pay an employee a salary, right, and that employee takes portion of that salary and puts into or buy any pre-tax transportation like Metro cards or qualified parking, that piece that they put away, you as the organization have to pay tax on. So the employee still has it tax-free, but it affects the tax-exempt organization. Now, again, this is very interesting code section because it's a non-for-profit. It's not like you generated any income to pay that tax. And I don't know if your funders or your grantees are going to give you any money to pay the tax, or even the government. And I had a funny situation. I'm a president for one of the non-for-profit boards, and we're approving the budget. And I asked them, where is the line for the tax? And they're like, well, we're asking the government for money. I'm like, yeah, but you got to ask this government to pay that government. And they all looked at me like, oh, crap, I think we got to do this. And again, it is really unfortunate, but as of right now, it is here to stay. So how do we define the qualified transportation fringes? Again, it's any Metro card, any transportation and commuter highway, any qualified parking. And parking is a whole separate issue.
Well, that's an entire issue by itself.
Right. If your employees just put money into that Metro card system, that's easy to calculate the tax. The parking is much harder. And the other piece of this is also if you're a New York City employer, you are subject to provide those benefits to your employees. Back in April, when we went to a conference in Washington, we asked the IRS, well, what am I supposed to do? I have to provide these benefits. Because their idea around it was stop providing these benefits. But New York City is going to fine you if you don't. And they had no answer. So this is the best I can tell you. As far as these taxes, the qualified parking has to be provided near your place of business or near public transportation. So if you have a lot that is available to employees, even if they don't pay for it or you don't subsidize that payment, that still could be taxable to you as the organization. Yeah, I know, don't look at me like I have 7 hats, but...
And this really is probably way more complicated than I think the transit passes are. There is some guidance that has come out in this regard. So Just by way of an example, let's say that you're renting your space from a facility, and you have 10 parking spaces, and 6 of those you use for your customers that are coming in or the people in the community that you're serving, and 4 of the parking spaces are set aside strictly for the CEO, the CFO,
Controller and
doesn't
another
matter
person.
who. But these parking spaces are set aside for your employees. And you say, well, they give us the parking spaces because of our rent. Well, probably the best guide would be to tell you how much are you paying for the 6 extra parking spaces, because it's the fair market value of the parking space. Now, the employee is not going to be taxed on it. This again is strictly going to part of this transit where the 21% is going to come into play. You're going to need to find out what the fair market value of those parking spaces are. And you're going to have to calculate that as part of the 21%. What's really, really weird when you look at the guidance that's out there on this, what happens if you own the parking lot? Okay, believe it or not, if you own the parking lot, you've got to be able to determine, like, let's say you've got a parking lot that's got 50 spaces in it, and 25 of those spaces you use for the community you're serving, but 25 of those spaces are actually being used by employees. You've got to go in and do the calculation of depreciation, security, repair and maintenance, whatever the costs are that are associated with that parking lot that you own. You have to allocate it to what is the portion of it that goes to the employees, and you have to include that in the pre-tax. Now, if you want to tell me a good way to be able to calculate this, let me know, because I don't know anybody else.
I think we have a question. Hopefully an easy one.
I'm just curious. You said something important before, like when you rent a space and you have to determine the fair market value. If you own the property, can't you use that same logic and say, well, there's no market value for these 50 spaces?
But
I can't lease out these spaces to someone else and make a profit on it. So can I say that
there could be a rental value to them
if there's a market for it? But let's say you're in a place where there is no market for that.
Do you have any costs, any snow removal costs, any upkeep, any
Right, but those extra 50 spaces are really, I mean, you could really argue that the cost of that is just for the programs. I don't know. I'm just throwing it out.
What's really strange is they don't tell you how to calculate it. They just tell you you have to calculate it.
Right, but I don't know. I like the logic of using fair market value, and there's no value in it.
But if you took, in this particular case, if you own the lot, you have to take into consideration the depreciation, the repair and maintenance, the security and all, and I think that would be for starters.
Yeah.
What the upkeep on the parking spaces. Didn't say it made any sense. I'm just saying this is what the law is.
Very good question. Thank you. Absolutely. It's very hard to determine what that is. And they did talk about, some of the articles do talk about the cost you have. Is the snow removal now taxable? Technically, yes. If you're trying to get around it, you really need to have really good explanation of why you think that this is not taxable.
Right.
Because the law is very blunt in saying what it is. And they do talk about the fact that it doesn't allow any deduction against that income. So it is very subjective. And again, as they try to come up with the siloming effect and how to determine that, they haven't determined how to account for it. Because I don't think they knew that this is going to affect so many organizations. Because the one thing I do want to say, this affects everyone, whether you file a 990 or not. As long as you have employees, you're subject to this tax. So that's really strange, because some organizations, like religious organizations who don't file 990s, will not file 990T and pay tax on benefits provided to individuals that they're employing. And again, this all has been raised. There's a lot of people trying to lobby against this, but as far as we know right now, this is not going away.
Right.
Because they needed to substitute that 21% rate reduction. So you're lucky because you're not paying at 34%, you're paying at 21%. But
Yeah, and
I don't know if anyone's happy about that.
one thing that did come up is again, we talked earlier about equivalent units. Okay, their equivalent units affects us also. Let's say you've got a group of employees that come to the office one day a week, and you've got parking. They're allowed to use the parking facilities, and so let's say that on an average, you've got 3 parking spaces available that are being used each day by somebody different from the organization because you've got people out in the field. You have to figure out the equivalent of full-time employees using that parking space. So, I mean, this is not easy. It really isn't. And one other area, too, that I think is extremely important is the state issue, just to mention very quickly. Because, again, whether this is UBIT or whether this is not UBIT is going to make a big difference from the standpoint that if you look at state tax returns, many of the states, in fact, most of them probably, will pick up that if you have unrelated business taxable income coming in on your 990 through your 990T, then you're going to have a state income tax return. Now, where you've got to look, the 2 biggest ones I can tell you that we run into all the time are New York and California. California does not conform to the federal, but California has said that this is not UBIT. There's a bill that was introduced, I guess it was in May. It's 11051 in the Assembly, and it's 8837 in the Senate. And both of those bills were designed toward exempting New York as far as this tax is concerned. Prior to those bills coming into play, Chief Counsel for New York said they were taxable. It appears on the 990T, you would have to pay the tax on it. Where one of the differences is that, as I said before, it really resembles something called the Proxy Tax, which is shown over on page 2 of the 990T, and this has to do with lobbying for basically for trade associations and so forth. IRS has said that for 2017 returns, which are going to be let's just use as an example, July 1st of 2017 to June 30th of 2018, you're going to be using the 2017 990T. IRS has said that this is going to go on line 12 on the front of the return,
Which is other income.
Which makes it income. UBIT. And so anyway, when New York when the bill first appeared in the Assembly in New York, it basically said for years beginning after. And so Mike McNee and we yelled and screamed at him and said, "These are wrong." You know, it was really funny. And just really quickly, I called one of the senator's offices, and after about 3 days, they called me back, and they said, "If I give you Governor Cuomo's phone number, would you give a call to him and try to explain to him why it's wrong?" So I called the number. I would have probably fallen out of my chair if the governor had answered his phone, but it was his secretary, and she said, "Would you please write him an email and explain to him why the bill is wrong?" So we did. So it went back, and it went back to the Assembly, back to the Senate, and it was changed to where the dates are correct as far as the implementation on it. And I called about 2 hours ago to Senator Renzenhofer, who's not a name I'm familiar with, other than the fact that he's one of the sponsors for this bill in New York. And he said that it is just sitting there in the New York Senate. And I said, well, you know, people would like to know what's going to happen to it. And he said that it's going to go to the governor to be signed sometime between now and the end of the year. He said, we don't know when, but he said the governor will get it by the end of the year. Yeah.
We tried.
What's that?
Mike said prior to November 12th, so we know what we're doing.
Yeah, right. Right. Somebody asked me, they said, well, why didn't you call him back? And I said, God, no, he might answer the phone this time. But apparently it's going to be exempt in New York, and that's basically the premise that we've been following. You know, because otherwise you would have to do this, the whole thing with the CT13 and everything.
Yeah, so thank you, Rob. I just wanted to point out that part of that law is also on-premise athletic facility.
There's a question, I'll go back.
And mainly, this will affect you if you have a quote-unquote private gym just for your employees, and that would be taxable. As non-for-profits, most of your gyms, if you do have one, are open to public for use, so that might not necessarily come into play. But if you're just giving a free gym membership to your employees, that's where that will be taxable as well. Cover some of the point Rob mentioned is the tax is being paid on Form 990T. They changed the rate. So if you have a change in rate, you would use a blended rate. But because the tax is effective since January, so for the 6 month for a 630-year organization, you would compute it on the 21% basis. Again, the 990T is being updated for future years. It hasn't been updated yet. We haven't seen a drop, but apparently it's not supposed to be treated and shown as other income. But that's how you have to report it for 2017. Rob, you have a question?
Yes.
Oh, thank you. Okay, since this is UBIT 990T, and once you figured out the fair market value of the benefit, are you allowed to deduct the maintenance, the allocated portion of real estate tax, the, you know, when they clean up the snow, no electricity, all those
No.
kinds of things, to get to the taxable income? No?
No, because, and I think the reason they said that is because if you own the lot, that's your only cost, right? So that's how they're going to figure out what's taxable to you. So they don't want you to make the tax and then take the same amount of money as a deduction later, and it will be zero, right? So the only thing as of right now that's clear you're allowed to deduct is $1,000 on a face of the 990T. Everything else is essentially 100% taxable.
Okay, that's not right.
Yes, that makes no sense.
You spend money for that property, for cleaning it up. You have a janitor cleaning it up for
They don't
snow
care.
removal and everything, and you're not
Tell your
allowed?
employees to park in snow or bring a shovel.
Jeez, goodness gracious, thank you.
No, I'm sorry.
Life can be awfully cruel, even in the tax world.
Well, then they wouldn't need the parking space and you wouldn't have to pay the tax. I guess that's the message, right? Sorry, but no, unfortunately, based on the way it's written, you're really not allowed to deduct anything against it. But again, if there's additional guidance that there's going to allow us to deduct some information, I'm sure we'll be on your phone with you very soon.
Okay, so my employer is actually planning to move to Industry City next year. And one of the amenities that Industry City offers is this van/bus that goes from Lower Manhattan to the office premises. Now, is that going to count for purposes of this?
So that will fall under the definition of qualifying parking from transportation from a place where you use a commuter van. So yes, that would be taxable. Sorry.
Yeah, just one more final.
I don't have any good news today.
Yeah, one more final thing, and I know, for instance, from our perspective right now, we are currently doing the extensions for the 990s, 990Ts for June 30th, which is obviously the November 15th. And we can't complete the extension on the 990T until we have the payment information. And there's, I don't think, you didn't mention anything about the registration, did you?
No, not yet. Actually, it's right here.
Oh, okay, good.
So generally, I know a lot of people are thinking this is a payroll provider issue because your payroll administrator has this information, or if you're using flex spending on direct pay, those are the people that would know this, but they cannot pay the tax. This is not a payroll tax; it's an income tax. That's why it's being paid on a Form 990T, and you as an organization have to pay the tax yourself. And you have to go to that website, eftps.gov. If you've never paid any tax, you would never go there. But that's the website where you have to go to register. You have 10 days, you get your PIN, and you can pay your tax. But the important piece, what Rob is mentioning, is part of this, because this was enacted in January, in April, you technically had a requirement to pay an estimated payment if you own at least $500. And if you think about this $500 is very easy to get to, because an employee can take out $260 per month for qualified parking, $260 a month for qualified transportation. So that could add up really fast, and you're subject to these estimated tax payments, and you haven't paid them, because in April, nobody knew what to do with this. In June, they somewhat knew more, but still were not very clear. So you're going to be subject to penalties off the bat. You haven't even done anything, you're going to pay penalties. And the IRS has not issued any guidance that they're going to amend the penalties. So the penalties are easy to go away with, but the interest is statutory, so you can't really abate that. So again, you haven't done anything, you're already paying tax and penalties on top of that. So right now, if you're a June 30 entity, in November is your estimated extension payment. So you can sort of catch up for the years, for the months you haven't paid the tax for. But you cannot file 990T extension and show zero, and then file a 990T with $1,000 to pay, because you're going to still be subject to those penalties. So if you haven't done anything and you're June 30 entity, you should probably go and register or talk to your tax advisors what to do about this, because that will go into be hard on you. And if you're an entity that actually waits till May 15th to file the return, you're going to be hit with almost a year worth of penalties. And these can add up really quickly.
And I think also IRS, at least at this point, has said, because of lack of guidance, that I think they're going to be pretty lenient as far as the
right, but they haven't said anything in public, right?
Yeah, they haven't, again, nothing in public, but they've inferred that they're going to
go
up on it. Yeah.
Right. So some of the questions that we've had is, what if I use professional employment organization? A lot of these entities are coming back and saying, well, I'm not going to take the deduction. But nobody is telling, do not talk to your tax advisors or do whatever you think is right. So I think because you're liable for that tax, you should make the due diligence on your side, confirming that if, you are subject to this tax and you're going to get a penalty notice, that they're going to cover it. Because as of right now, we haven't seen one organization coming out and saying that they'll do that. All they said is, we'll try to determine that it's not you, but there's nothing set in stone. And more importantly, on your 990, if you're showing that you have employees, it's going to be very hard to tell the government that you don't have employees.
Yeah, New York also has rather peculiar laws about who are common law employees or not. So in some cases where you may think that you don't have employees with your organization, particularly from a New York perspective, you do, because it's got to do with who controls the employee.
Exactly. Some of the things Rob mentioned about the state taxes, if there's no state UBIT, you wouldn't be subject to tax. But what you do have to think about is if you have employees in a particular state. The way 990T works and state works, the state picks up the 990T federal income tax. But if you don't have any employees in that state, you're not going to be subject to tax there. So you really have to look where you have employees. California did say they're not taxing this, but none of the other states did. So that's something you would have to look into by individual state basis to determine. Again, New York is up in the air. Hopefully before December 31st, we'll hear from New York. And we did talk about parking already, so I think we answered that question. Okay, any questions?
You have a volunteer who, if you have volunteers, and volunteers in some organizations are perform a large percentage of the work. So they're not an employee, but it's not delivering a service as part of your program, and you're taxed for your employees' use of the parking spot. Where does the volunteer's use of the parking spot fall in?
I would come to the fact that they're not your employees, and it's no different than somebody coming to help you with something. So you would probably have to come back with this equivalent units and determine how many or how much. I mean, you really have to look at 24 hours a day parking spot that's being available, because some of the situation I run into is We use it for our employees during the day, and then the college kids come in and park here, right? So now we have 24 hours. We have to account for time that's being used by our employees. So it's really dissecting everything and how that parking lot is used. But for your employees, I would say no.
Yeah, in the IRS guidance so far, they actually use the university as the example, to where you've got the employees during the day and you've got the students at night. And they go into a rather drawn out explanation about how you have to allocate it.
Matt, could you please pass microphone? You don't have a microphone? Okay, I'll run.
Here, go, go.
Yes. Yes, for December 30. I said I have no good news. If you're a December 31st entity, you were supposed to pay in April, in June, and September 15th. So if you haven't paid anything today, what I would do is do the calculation and pay that as soon as possible. And then fourth quarter will be December 15th. And catch up payments in May. Any other questions on the parking? See, I told you I left the good for last.
All right. You mentioned that expenses are not allowed in terms of rent, but what about on this one, when you have third-party vendor who manages this flex spending?
No. Yes, $1,000 deduction. And hopefully they're going to come up and give you some guidance, because one of the example was, what if I have a parking attendant? And the way they came back and said, well, if you have a parking attendant and own the lot, that's your taxable income. So we're not going to let you take deduction for the parking attendant that you paid to be there. I know. I hear you.
You said to start making estimated payments for 18 and 18, but isn't minimum payment based upon what you had to pay in the prior year, which would be 0?
So the safe harbor is that if you filed a return for prior years and had 0 liability, you wouldn't have to pay. But because you haven't filed a return, you don't have the safe harbor.
But I filed the 990T and had losses.
If you file 990T before, yes, then you could go off the prior year return unless you more than 90% of the liability for the year. And at that point, you would have to pay that. They're cutting me off. So any other questions, come see me or Rob or write them down and we'll try to answer them. Real quick, some of the 990 changes, really there isn't much. There's donor disclosure that was passed real fast. Nobody's happy about this because it does not affect 501c3 organizations. And some of the information that you heard before, based on the changes to financial statements, they did issue new instructions for the 990, and the important piece is that donor net assets with donor restrictions and without donor restrictions. So the with donor restrictions are going to go on the unrestricted line, and with donor restriction, it's really at your discretion to determine where you want to put them. I figured that might be important for some individuals here. And the 990 and 990T are being updated for the new taxes that we mentioned.
And what's interesting about that, they just came out with the 4th rendition of what the 990T is going to look like. And they can't make up their mind how they're going to report on it.
Thank you very much.